I grew up a very poor kid in the Bronx. First day of my life when I lost $1 million, I didn't jump out the window, but damn did I look out that window. You need to have a broader look, a higher level than just looking down a microscope and saying, wow, I see Google. Sometimes in investing strategies, you need to put yourselves into an investment position that is defending against what you like. I bought it at $1, so I bought more at 75, and I bought more at 50. That's the moron trade. People have crystal balls, nobody I know does. I say to myself, what is the advantage of like this buying and holding all the time? And when you start hearing too much about something, that's the bus trade.
Investors, welcome back to another go-round worth of Masters of the Market. This week, I have on with me the COO of Next Gen EMP, Bob Coakley. Bob, welcome to Masters of the Market. And as we always do, I just want to dive right in with you into today's episode and pass the first question over to you, which is, what exactly is your story? How'd you get to where you are today?
I thought about that because I'd seen a few of the podcasts, and it's funny, I said to myself, how far do I want to go back and answer that? And, I grew up a very poor kid in the Bronx. Started working, hustling at a young age, paper route, and got a lot of experience at Carvel. I don't know how many people out there have heard of Carvel, but Tom Carvel was one of the early pioneers in franchises, and I fell under his wing as a kid. Literally started like 13 years old working in a store there, and had a lot of fun. But I ended up working for him in corporate through high school, through college. They've got Bunny Robin and Bunny Robert, the Easter Bunny cakes. They're named after my sister and me. But my claim to fame there was the crunch in the middle. So with the franchise size of the business and things that were, back in those days, a lot of the franchise people were cutting corners on making the crunch. They had to put this brown bond in it. It was expensive. And it used to drive him crazy. So on my early stages with that, I came up with the standardized crunch that came out of a bag, and everybody had the same crunch, and it's still in Carvel cakes 50 years later. But that was my early side of business. Athlete in school, double major in accounting, finance, all-American swimming and water polo. So I had a little bit of an athletic background. I got driven to finance. I loved Wall Street. I always wanted to go there, and that kind of led me to Fordham in Bronx. Fordham University has a good reputation with getting people onto Wall Street. Graduated from there, started working at Neuberger and Berman, and was doing risk arbitrage. And Michael Milken, that whole phase was going on, and that market turned upside down, like right there, 84, 85. I was like, oh boy. And I made my path over to the New York Mercantile Exchange. Loved commodities, when I was a kid. Dabbled a little bit in silver, bought some silver coins before the Hunt brothers cornered the market, and it's just silly stuff like that, but was always driven. I was a street kid. I could play poker pretty well, and 3-card Monte. Enjoyed quick with numbers, arithmetic, none of that crazy trigonometry, calculus stuff that the average guy that's in writing algorithms, I can carry my own, but I was a numbers guy, count the cards as quick as they can flip them over. That was one of the things as I progressed on Wall Street, one of the things that I enjoyed was I hired a lot of people over my lifetime in my career down there. And I would give, the new employees, the clerks, a deck of cards, and I would tell them on the way in commute, I want you to flip the cards over and count them. When you can do them faster than a minute, come show me, And it was a great asset for them to, practice. I mean, no matter how you shuffle the deck and you turn them over, at the end, if you're right or wrong, because the number's always going to be the same. But back to how I got to where I am today. Part of being an athlete helped me on the floor of the exchange. You get a competitive nature, and it's like, almost like being in a high school, college football room, day in and day out. You're grinding it out. And I enjoyed that, but more important for me there was it taught me a significant amount of how to mitigate risk. As I progressed, I started out working for, another group. Then I had my own company, sold my company, focused on my own trading, and became a relatively large market maker in the oil sector. I traded crude, heat, and gasoline, would have thousands of futures contracts on and, pucker up some days, seven-figure, potentially making and losing in a day when you're a young guy is scary when it's your own money. And for me, what really resonated was, how do I provide markets for you going, making a market for Goldman, Hess, Enron, these guys get, physical delivery, they got everything they need, and you're standing there with your brain, and, they're asking to make them a market, and they don't want anything more to do than run you over half the time, and you've got to hedge it and lay it off. So I really, really enjoyed the challenge of that, but understanding how to mitigate the risk, running from the heating oil pit to the crude oil pit to offset it, trading the first month against the third month. We would spread risk, having a bullish position in the front of the market, knowing that potentially something could happen in the world, and how do I hedge that? So it really, really helped me understand the way markets flow. I didn't just trade heating oil. I traded heating oil, crude oil, gasoline, natural gas. I traded the first month, the second month. In crude, I would trade 36 months. My position would be all over the place. More important was, I saw the guys that were down there for a long time. What they were able to do was to limit the days that they lost a lot of money. You had to be able to come back the next day and fight again. So that was something really, early on that I took to heart. Sadly for me, when I retired, I left the floor. 9/11 was pretty tough. I was chairman of the floor committee at the exchange at the time. I was on the board of directors, and I lost like 23 friends, and the year before that, my sister, she had a brain aneurysm, young woman. Mom died when she was 42 years old, and I was like, wow, I'm making all of this money and looking around all these things, and I'm like, you know what? I think I'm going to check out of this in a little while. So I bought a place down in Florida and started to build it, worked to semi-retire and leave the floor. But I always loved trading, and I enjoyed it. In 2004, stepped away from the floor, traded, on screens, markets were migrating, and learned a little bit about looking at the markets instead of, intraday and then, daily, weekly, monthly, to take a further step back and look at the broader markets, the broader way money migrates. I laugh to myself. I mean, I think the stock market is an extremely funny and unique place that people put their money. I still can't comprehend how companies lose 50% of that value in a couple days. The price activity. Ari, how many times have you seen in the stock market a 25% fluctuation in a stock in a day? Look at you, United Healthcare.
I was going to say, just the past couple of weeks alone, I think we've been in this volatility where it's like every day you don't know what's coming.
No, and so that's the important thing, I think, of, what I learned trading in the pits on the Florida Exchange and having, fun times with that, with learning, is how do I position myself to be in the market, but to be able to eliminate in environments like that. And, I go back to a real funny story. Because a lot of the decisions that I make investing, I would consider myself a professional, and I was dating my wife at the time, and I don't remember if we just were getting married or just got married, but we had dated for about 4.5 years, and her father said to me one day, he goes, hey, you do that stuff with the commodities, right? He says, you know heating oil, and I'm like, yeah. He says, how do I get long some of that heating oil? And it was like a Sunday night, and I looked at him, and I said, what? He goes, yeah, I'm hearing all this stuff about heating oil. It's going up, it's going up. How do I get long some of the heating oil? I said, Jimmy, you know what? You're going to get short some of that heating oil because I'm getting out of my position on Monday. He says, well, what are you talking about? I says, if you, a steam fitting guy who wants to get long heating oil, it's time for me to get the hell out of this. You know, and it was early on. I called it the bus trade. You know, when the professionals were getting off the bus was when the common person was getting on. You know, and what did they do? They talked the market up, and they here's hold this bag of what's coming. You know. And I never forgot it. I mean, I had a massively long front-end position in heating oil, and the first day the market was higher on Monday, and I'm unwinding it and, trying not to tip my hand too much, and I'm unwinding it, and I'm making money that day. And following day, Tuesday, market's like struggling a little bit, and I'm out of about 50% of my position. And by day 3, this thing dropped like a rock. And I mean, I basically broke even on a position that hadn't it been for him asking me about, how do I get long this heating oil stuff, I would have learned a big lesson early on in my career. With that said, that's why I believe bus trade, the herds, the sheeps and stuff, you have to have diversification. But more important than that is you have to look at the market holistically, I think. And money migrates, money moves around. I think there's like 10-year cycles. When I say 10-year cycles, you'll go through, commodities will be hot, real estate will be hot. Then, these are cycles. And the smart guys are moving this money around. And when you start hearing too much about something, that's the bus trade.
Bob, I want to zoom out for a second because you have so much experience. And when I want to circle back to all of this, where did it even all begin, this fascination, curiosity, and determination to be on Wall Street, involved in trading and finance?
I truly loved numbers. I mean, numbers are a gift to me. I mean, to this day, still, I see numbers, I think, very different than a lot of people, and I can calculate things very fast in my head, and I compare it sometimes to, like, certain athletes, a baseball player, Those guys, some of those guys can see what the lines on the ball are when the guy lets it out of his hand. I can't do that, but I can tell you right now, the lines on the balls I can see with numbers and put things together in the markets.
So when it comes to overall strategy, because I've had a lot of investors on Masters of the Market, professional investors, the average Joes, everybody in between. Some people are great at math, other people not so much. Do we need to be good in mathematics, or, and if we're not, do we just go to ETFs? Like, how do we play this game of investing?
That's an interest. I mean, so from a high level, the way I look at it is this: what are you trying to accomplish? What's the objectives? I'm going to go back to, my life story because I was, going there, and it's going to tie right into what your question was. So pick up '04, kind of take my big chunk of change, beautiful house in Florida, and, not to say anything bad about Merrill Lynch or anything, but my wife was an employee there that when we moved to Florida, she left, and I had, one of the top brokers at Merrill Lynch who was managing my money, and I hired a bunch of guys, and we went fishing. We fished like Forrest Gump ran, we fished 200 days a year in '06 and '07, and, 08 happens and '09 happens. I wasn't paying attention to my investments in the stock portfolio. I wasn't following it. It was like, yeah, I'll talk to the guy, have dinner with him once in a while. I wasn't really following it. I thought I had more than enough to live happily ever after. I got my clock cleaned. I still have a tax carry forward that I still trying to earn enough in my investments to clear out a tax carry forward. The number was staggering. And that's when I got punched in the head in, 2009. I mean, I had what, everyone, you got a balanced portfolio, you got this, Can you imagine having GM bonds, okay? Find out that they were unsecured GM bonds, and that, you know, your $2.5 million in great General Motors is now worth 10 cents on the dollar. And the way the government restructured the whole market was very different than what I learned when I studied my MBA, you know. So I think today's very different than in '08, and very different than in the 80s and 90s and 2000 when I was trading in the energy sector. I'm a big supporter in ETF, exchange traded funds. I think that the tax structures and the advantages today, you know, I think there's some 4,000 ETFs, so there's probably, you know, 90% too many. I mean, I follow probably 500 of them regularly now because that's what I do for our firm is, you know, I put the portfolio together and work with an amazing partner, Wayne Pinella, who you've met with, and he's a brilliant mind. I mean, he wrote an algorithm, and I have the luxury of playing with him in that algorithm and picking ETFs. And why we use ETFs is because both of us agree that, you know, idiosyncratic risk is scary. You know, individual stocks, no question. For decades, you had to have the ability to pick, like, you know, early on, you know, like an IBM, you know. Well, at the end of the day, IBM reinvented itself, you know, but if you take the Dow 30, do you know how many of those stocks that originally were in the Dow 30 are still in there?
I'm going to say none.
Right. Right. So when I look at things like that, I say to myself, you know, what is the advantage of like this buying and holding all the time? Why are we so conditioned, you know, from all the experts to get your portfolio and buy and hold? I have friends of mine. Well, I heard about, you know, the Magnificent Seven. Magnificent Seven. Well, where are they? Where are they the last, you know, 60 days, 90 days? You know, oh, I don't want to sell my stock. That's another thing that I hear. I don't want to sell my stock because I don't want to pay taxes. You know, I promise you this, Ari, one of the happiest days I had in my life was in 1992 when I went to see my accountant, and he told me I owed $1 million in taxes. Okay, poor kid from the Bronx. You want me to pay $1 million in taxes? And I jumped up and down. You know why? Because I made enough money to have to pay $1 million in taxes. So a lot of people spend too much time worrying about paying taxes. Now, I'm going to get shit about that. Oops, can I say that?
Too late.
You might have to cut that one out. But yes, I mean that you should look at tax efficiencies and ways to like mitigate what you pay in taxes. But why not sell a stock? Okay, you have a stock. It's gone up, you know, 10, 20 times. It's, you know, you pick this amazing stock. All right, the market sentiment and things are shifting. Do you hold on to that or sell half of it or something? But you don't want to sell it because you don't want to pay taxes on it. And now that stock does exactly what you were afraid of. It drops 25, 50%. What did you gain? Now you want to sell it when it's now down, and more likely that's where the bus trades is. All you guys are selling and the professionals are buying it. You know, you should be buying it then. I'm not that good enough to tell you when the highs and the lows are. I can tell you a lot of times the trend is your friend. You know, that was a big thing trading commodities. You know, the trend is your friend. And commodities, that hold true. But when that train stopped and went the other way, it's a pendulum, man. It could swing, and next thing you know, you're standing there going, whoa, what just happened? I like the way the markets have evolved with ETFs because now you have two advantages. You have the tax efficiencies of them. We've got an algorithm that looks at the market holistically, and then we find that we don't want to have idiosyncratic risk. There's more noise. So we look at various sectors. And that goes back to what I was trying to say earlier, is that money moves around. And the algorithm has the propensity to tell us what's the dogs and what's going to be the ones that overtreat. And it's what I would call it's a foggy ball. You know, people have crystal balls. Nobody I know does. 69% of the time, you know, the market historically goes up. with our foggy ball, we get that lifted to about 80%. The goal is diversification, okay? And how do you diversify? Well, we use ETFs because they have diversification in them. You could have the home construction sector that you like and pick a couple of the stocks in that sector, or you can have an ETF, and 3 companies have created ETFs, or 4 or 5 at this point in that sector, and they're all competing against each other. So there's a gift in that, in where that is. And the S&P 500, there's 3 ETFs right now in the marketplace there that have almost $2 trillion. $2 trillion in 3 ETFs. That says S&P 500. It's not a true reality. I mean, effectively at this point, you're talking over 40% of the value of the S&P 500 is 10 companies. So what I do is I look at all the available sector ETFs in the space. We look at metals, oil sector, we look at healthcare, home, consumer discretionary. Look at the whole gamut of the marketplace. Treasuries. I mean, you can buy ETFs now that have leveraged treasuries in them. And the objective is to try to balance, look at inverse correlations, and look at what if this goes higher, this will go lower, and sometimes that's a good thing. So you could effectively put a portfolio together with ETFs where you sometimes are cheering for one of your ETFs to underperform because the weight that you have in that ETF is less than what the weight is in the one that you want to go up. So it protects yourself.
Here's a big question for you, though. Whether it's ETFs or even individual stocks, and I almost feel I have the answer here, but I want to just throw this out for everybody. With an ETF, the buy and hold strategy you're saying is totally acceptable, green light. If you're holding individual stocks, I mean, the buy and hold strategy, good luck.
I think a managed ETF, you can buy and hold that forever, provided that the people that are managing it are performing. You want to look at quarterly returns on that ETF, 6-month, 12-month returns. You want to see if their standard deviation is getting wider, if their Sharpe ratio is still high. If you're in a managed ETF and they're underperforming, the SPY, well, why do you want to be in that? And what's happening now is that a lot of these money markets and bigger houses, to compete in the space, they're putting ETFs out there. The days of the 2 and 20, those are over. That's why I think the ETF market's evolving. You've got leveraged ETFs. If you're a younger person, you want to take a little crapshoot and a little extra, you can buy the MAGs, which is an ETF, and then you can buy the MAGs on steroids. You can buy a leveraged one. That stuff's a little crazy. I mean, that's the investor's choice on how risky they want to go. But as an individual investor right now, you have opportunities where you can buy something in the marketplace that is doing a tremendous amount of service for you where you couldn't. Like if you had money with me and it was a separately managed account, you're subject to paying taxes on our transactions, and some of them are short-term transactions. With the efficiencies of ETFs now, you don't have to pay that tax most often. There may be some, depending on how they recapture the reweighting and the rebalancing. That's a brand new instrument out there today that people can be a part of. When you say to me, buy and hold stocks, I mean, if you bought Apple and you held it, if you bought it when I was in college and you held it, damn, you got a lot of money. So I don't want to poo-poo historical methodologies and stuff like that. there are companies, like Nvidia, in the Magnificent Seven, Facebook, and I can tell you a funny story about co-ed, but when it was the Facebook, we came out with My College Daily. Unfortunately, we didn't win that one. So, but we had a social media I was investing in some years ago. But back to the difference between what I think and stock investing is individual companies is you don't know, like Elon Musk. I'm trying to be apolitical. He was the poster child for clean air and electric vehicles, and large group of people bought his vehicles because of what his objectives were and everything else like that. And you own Tesla stock, and then all of a sudden he gets himself into a political position and he pisses off half the people that own his stock. So what do? That's sometimes the problem. United Healthcare. These are solid companies that watched 50% drops in their cap, which I still don't, I can't comprehend that. In the commodity market, you had to take delivery of it at the end of the month. Okay, so you could price manipulate it a little bit, but when that oil tanker showed up and you owned it, you had to take delivery of it. So,
well, let's talk for a second, about, as you shared, whether it's a Tesla or a United Health. There's a gamut of investors out there that would say, Bob, those are the opportunities right now. If you are the buy and hold type of investor, there's obviously a case to be made for that. And on the other end, nobody knows the future. So there's a case to be said about that. Now, with decades of experience that you hold, it sounds to me like you're almost just saying, put all the kind of gambling chips and the cards and everything on the side. This is your money you're talking about. So let's remain focused on what works and just stick to that strategy with ETFs.
Let's dig deeper into strategy. I believe that a balanced portfolio for an investor is time depending on their age, their ability to continue to put money in as opposed to take out. And as things shift, as you get older, I don't need to talk about this. You probably had everybody on here tells people how to do it. So I'm gonna get into the trading weeds of it. What I think is more importantly, no matter where you are in that input or output, okay, you have to have a portfolio that is diversified. And when I say diversified, I think that you need to have different sectors, whether it's part of your portfolio is in a real estate, part of it is in a commodities, and when I say that, I'm going very high level. Okay, like you could take GLD, all right, gold. Gold has been a dog and now it's hot. Okay, when these things start to heat up and money starts to move into them, money's coming out of somewhere else. You understand? The money is shifting, and the guys like me making decisions are moving money around. So what you need as an investor is to have these different, say, sectors that you like, whether it's the utility or the construction. In the S&P 500, they're all in there. Your technology, you see what I'm saying? But if you break those pieces out, and you own, as an investor, whether it's two or three stocks in the tech sector, whether it's 2 or 3 stocks in the healthcare sector, whether it's utilities, whether it's energy. What do you think's going to happen to energy stocks when you just come from 4 years of a presidency that was trying to limit things in a sector? What people don't understand is that those sector did pretty well. Why? Because they were putting no capex out. They weren't building anything. So they were bringing all this money in, paying a higher dividend. And so you would say to me, oh, the oil sector is going to do really well now that, we've got a new president in. I disagree with you, because now they're going to go back to exploring. They're going to go back to spending money. If I was in the oil sector, I would probably be looking to move my money maybe into uranium, and again, the bus trade, so you got to hear the whispers early. You're hearing about energy shifting now from, solar and other things like that. You hear all the conversations about the demand for what's going on to capitalize electricity to support all of these AI. I think it's still an early whisper. Money's going to migrate into that sector. And that's what I think as an investor, you need to have a broader look, a higher level than just looking down a microscope and saying, wow, I see Google. Yeah.
Well, Bob, let me ask you this. I mean, again, you're someone with decades of experience on the street and experience off the street even, a lot of success. There's some of us out there, I'm sure, that are putting our ears out the window and saying, I don't hear a damn thing. There's no whispers. There's no yells. I don't even know where to look. So how do we reach those investors and say, get your head on the swivel, look here, look there, listen in here, right? Because those investors are the investors that are putting the microscope on Google and saying, let me just buy this.
Wow, Ari, I got to tell you, I didn't see that one coming.
You bring out the best of me.
Yeah, well, and I've got to take a step back and laugh and say to myself, okay, so how do I answer that? And for investors that, if anyone's trying to manage their own money, they're spending time reading different things, watching podcasts like yours. You have to be able to weed out the garbage, the emotional news. And you got to really, I stand on a political side, but I don't invest on a political side. I'm not going to sit here and say that I don't have, some opinions on different things. But when I invest, I try to look at what's going on in the holistic environment, like the tariffs. Great example. I told people in the summer, okay, I'm going to go back just to reminisce for a second, okay. I was relatively early in my career, and I was trading crude oil a bunch, and I started to buy a bunch of crude oil up, and everybody's like, what's he doing? And I'm buying a bunch of options, and I believed, that politically the markets are driven a lot by elections, and I don't know if Joel Lieberman, does that name ring a bell? He was Al Gore's vice president during an election cycle. And no disrespect to Israel or anything, but you'd appreciate this. They were leading in the polls. And at the time, OPEC was very powerful. And I believed that they were going to try to run up the oil market. And I really believe politics have underlying issues to them. But I bought a ton of crude calls, and as people started to look at what was going on in the election, they started cutting crude production. Crude production, things happen in the world. Now, I don't know if Joe Public's going to get his ear to the ground and hear or see something like that, but, that was one of the first times I made $1 million on a trade. So, but you got to weed the noise out. Would I buy Tesla right now? Yeah, I think it's undervalued. I think people got emotional. They're the PE is still the PE is ridiculous. Now again, if I'm calling balls and strikes, it's grossly overvalued on its PE. But I think it really suffered from more of an emotional point. And then let's go back to the trade tariffs. Where I got sidetracked off of. The trade tariffs are affecting the market, but far more emotionally than what they should. All right. This year in the market's going to be what I believe choppy, because you're shifting dollars. Again, that's what the important thing in investing is money flow. You're shifting dollars from different sectors. I mean, the healthcare sector right now, when you hear about cutting funding to Harvard and cutting funding to different schools because they're not following along with this, that's affecting research. So do you think the healthcare sector is going to be strong here? I mean, these aren't complex. These are things. So if you had exposure to something like that, maybe it's time to lighten it up. You see what I'm saying? And move it into another area where you can hear and see things that may be going, in the right direction. Things don't stay. Like we pointed out, 30 stocks in the Dow, all gone. So, this buy and hold and never look at it again is not where we are in 2025. There's always going to be innovation. The semiconductor space, that's blown up. That's been absolutely a great investment. Do I still think it's a good place? I think if you can pick bottoms, and when I say pick bottoms, doesn't mean, I'm guessing to get in. If it pulls back, you buy some. If it pulls back more, I don't believe in moron trades. That's one thing I will tell you. All right, that was in my career, guys. I bought it at $1, so I bought more at 75, and I bought more at 50. That's the moron trade. If you bought it at $1, and when it got down to 75, you thought it was a sale. You bought more. You're a moron. I got to leverage. I got to leverage in. No. There were times in the pit where I was long and the market was going up and up, and guys in the pit be like, why are you still buying? Why aren't you taking a profit? Why aren't you selling? And I'd look at them and I'd say, are you bullish? Yeah, I'm bullish. So why do I want to sell it? So you're long NVIDIA and you hear that, there may be a problem or the market's getting toppy. So I'm not going to sell it because I don't want to pay taxes. That's another great example. Sell it or sell half of it and then reload if it comes down. And if it goes higher, no one's going to tell you you're a moron if there was $1 on the floor or $100 on the floor and you stepped over it because you were hoping that $100 became $500. $100 on the floor, pick it up. That's. I think that there's enough. During COVID, a lot of your generation, younger guys, started day trading and investing. I think day trading is a challenge. It's certainly as an individual. Without, we had an advantage on the floor. It was a funnel, all news, everything came into it. Now it's fractured. It's not as easy. The market makers have a huge advantage. They're buying and selling on the bid and offer. As an individual, you're trying to get in the middle of stuff like that. You're following charts. People can do it. There are successful people at it. Option trading strategies are a great way also. But as an individual investor, what I would tell you, here's the gravy, is look at different sectors. And if you want to trade individual stocks, go in and study the stocks in there. But always have yourself where you have diversification. Look at the correlations between these different sectors, and don't have technology, semiconductor, QQQ, all heavily weighted in a certain sector and nothing in another area. Balance off your risk and your exposure. And sometimes you want to buy as a defensive, like the utilities right now, XLU, it's going to underperform. Its beta is lower than what the S&P is, but it's not going to underperform when the market goes down. It's a hedge. So that's the way, I think sometimes you want to position. You can't pick highs and lows, and I don't care who you are. Anyone tells you they're doing that, tell them, open up your books and show me your papers. They're full of, they're lying to you. I have to, every day you guys can see what I have, and we unfortunately I'm out in the public. But I love when the guy tells me, "Oh yeah, I bought Nvidia," and okay, well, did you sell it last month before it tanked? No. Sometimes in investing strategies, you need to put yourselves into an investment position that is defending against what you like.
Absolutely. I mean, it's what you were saying when it came down to politics and, getting your emotions out of this entire, I don't want to say deal of investing, which is what I want to ask you about because, I feel I have another podcast. My buddy and I actually talk a lot about, don't get married to a stock. If you need to get rid of a stock, you need to get rid of the stock. The problem I think a lot of investors have and struggle with is this notion or idea that once they buy, they'll never sell. They're married to it, and this kills them. And I call it, emotional investing. You can't be emotionally invested in the market. You're going to lose. It's almost like the mafia-esque. It's nothing personal, strictly business.
Well, I will tell you, some of the best traders I saw on the floor were the guys that were divorced 4 or 5 times.
You learned the hard way.
Well, I was joking about that, meaning that you gotta. But there's a time and a place to get out, and don't stay married to certain things.
Do you think this? I mean, you just have to suffer at some point or another to really learn this lesson, or can some young buck take the wisdom that we're sharing now and implement it and be fine? I just haven't met a lot of investors who were able to successfully take the wisdom and implement it successfully.
Sadly, Ari, I agree with that, unfortunately, and I say this to my business partner, Wayne, he's got a brilliant algorithm, and you can give that algorithm to 100 people, and AI, trading AI and stuff like that. Garbage in, garbage out. You don't know what's right or wrong. You can't, these are life experiences. When I, first day of my life when I lost $1 million, I didn't jump out the window, but damn, did I look out that window, and you can't take that away. You can't unlearn that. That really, the kid that puts his hand in the fire, if he does it again without putting a glove on or something, that's just a dummy, So it's hard to learn sometimes. My uncle raised me, and he was a Marine drill instructor, and many times he would say to me, "Do as I say, not as I do," and I would do what he told me not to do because I had to learn my own life experiences. And as I got older in life, I said, "Shit, he would have saved me a lot of problems if I just listened to him." So I think you can learn a lot. But there are certain things that we all need to make mistakes. That's what makes us better,
Bob, before we wrap up here, and I'm going to say this now, we got to have you back on. I feel like creating a new segment, like, I don't know, Sunday Whispers with Bob. Just what can we hear out in the street for those of us a little more challenged in that department?
The problem, Artie, is that my mom always used to tell me, "Bob, put the filter," and I'm sitting here with this temporary filter on, trying not to say anything that you got a blurb. So I'm trying to be myself and be real, but there's a little more. There's a little more. If we could put a disclaimer up, maybe we could do that weekly thing.
Authentic Sunday Whispers with Bob. We'll put it that way. What comes out comes out. As long as everything's authentic. Bob, I want to ask you, and I want your authentic, real answer, truth on this answer here. There are a ton of investors out there right now who are trying to, of course, the get rich by what I always like to say Tuesday, as fast as possible. But there's also this other branch on that tree that they're all in on passive income, dividend investing in order to retire early or financial freedom, right? Financial independence, retire early. really quick, what are your 2 cents on that movement or this investing? You know, I don't know if I want to call it a strategy per se, but means to investing on just the basis of financial freedom. Is it achievable? Are we fooling ourselves?
Well, I mean, I got kicked in the groin, you know, when I left Wall Street and retired. You know, I was looking at the time, and you know, again, what I do bring to the table is probably 45 years of market daily studying, and I will clarify this very much, that as Americans and most investors, we got the shortest memory there is. You know, and fundamentally, go back 5 years ago, people 5 years ago were happy with getting 2% returns on their fixed income. You know, but inflation is, the goal of inflation traditionally is, you know, high twos, low threes. So they're putting money in fixed income at that time, and they're barely keeping up with inflation. Okay? So when you're in an environment like that, people are putting more risk at work. They're putting more into real estate and stocks, but you know, now you have opportunities of 4.5%, 5% fixed income. Do I think if you're older right now that you should lean into that a little bit? Yeah, I do. Okay, but you always, if you want to keep up with inflation, you have to have in your portfolio things that are going to get 8, 10, 12%. And the standard deviation and that you know, your risk tolerance and the beta has to be something you analyze. And the younger you are, I think the more, you know, take that chance. But it's risk reward, and it's very hard as an everyday investor to be able to outrun the fork for me, that when I'm fat, or outrun inflation. So, you know, it's hard. But I think today, I really sit here today very confident that there are mechanisms out there where you could, I mean, listen, if you want to buy and hold the S&P, you're going to own, you know, you'll have 10%, 12% return. But if you buy it at the wrong time, you could have negative returns for over a year. You can do that when you're a kid. When you're my age, that's a pucker up moment, you know? So I love the ETF space. I think right now you have hedge fund managers that are putting out to the public. I would encourage almost anyone that's listening to you or this, for them to go out and look at some of these managed, you know, ETFs and compare them. And I'm not going to sit here and poo-poo on dividend stocks. I think, you know, a holistic approach is something that investors need to do, but really understand that the big guys out there, money moves around, and you don't have to be the first one to the dance, but you know, if you can get in, you know, while it's still going, and get out when it starts to go and move around a little bit, I think that's very important. That I'm not a big fan of stagnant investing, you know, and when you're a kid, take some more shots, you know. When you get to be a little older, you still have to be able to keep up with inflation.
Investors, consider this one of 2 episodes here, if not more, with Bob. Bob, I want to thank you for jumping on Masters of the Market with me, and really, until the next episode that we get you back on here, investors, from the both of us, we'll catch you in the next one.